I'm Jason Stipp, site editor for Morningstar.com. It's gloomy here in Chicago, but we've got some bright minds and bright ideas for you today. We've got 5 sessions and 1 video special. You won't want to miss any of it. We're going to start by taking the market's temperature with a panel discussion this morning. I'd like to introduce some panelists that we have here today. We'll be talking about how the economy might be affecting the markets and how you may want to position your portfolio. We have Charlie Bobrinskoy from Ariel. He's Vice Chairman and Head of Investments for Ariel Investments. Thanks so much for joining me, Charlie.
Thanks for having me.
Michael Fredericks is Lead Portfolio Manager on BlackRock Multi-Asset Income Fund. Michael, thanks for being here.
Thank you.
And Bob Johnson, of course, is our Director of Economic Analysis. Bob, thanks for being here.
Thank you.
All right, so let's start out at a high level and just talk about the economy very broadly. So if you look at the economy month to month, if you're looking at retail sales, if you're looking at manufacturing data, it can seem like we're going through periods of booms and busts. The data is very noisy. But when you dig underneath the month-to-month volatility and noisy data, what does the actual real economy look like to you? Are we strengthening? Are we weakening? Charlie, let's start with you. What's your take on what the economy is really doing?
You know, we've been surprised at how pessimistic people are about the economy, which frankly we think is pretty good. We've had obviously a long period of steady gains in jobs, a long period of dropping unemployment. We think that people are excessively afraid of the economy. Obviously 2008 had a massive effect on people's psyches. People are looking for that next big recession, which we don't see anywhere. We got a lot of tailwinds in our views. We got a very strong auto market, we've got a better housing market, we've got low interest rates, low energy costs, lower unemployment. We think there's a lot to feel good about, particularly in the U.S.
Michael, we haven't had necessarily the kind of growth that you would normally like to see coming out of a downturn, but we've had a very prolonged period where we haven't had to deal with a recession since 2008. How would you characterize the sort of slow growth environment that we're in? Is this something that you think is positive, that it's been so long in going, or is it not growing fast enough for us?
I think it suggests to us that it's kind of a bifurcated economy. So yes, they totally agree. There are pockets of strength and there are pockets of weaknesses. You know, the housing markets, auto sales have been good. The consumer spending has been okay. We've been buying a lot more stuff, but the price of that stuff is in general been falling. So real retail sales haven't been so impressive. Manufacturing has been a bit of a different story, particularly over the last year or so. So consumer looks pretty good. The manufacturing and industrial side of the economy, not so hot. And I think that translates into another year of growth, which is just okay, 2.25% kind of GDP growth. And when you look over at some of the overseas markets, they're not doing so well either. You've got Europe growing in the, let's say, low 1% range, and Japan's a whole other can of worms. So I think it translates into a continuation of a world where overall growth is not that exciting, but not bad either. But at the level of growth is what I think is really complicated for investors, because it doesn't take much in terms of a slowdown in data for it to feel like we're hitting stall speed, and people get very anxious that we're going over the edge into recession, and that leads to big sell-offs and real choppiness in markets. And unfortunately, that's the environment we think we're in.
Bob, you've often referred to the economy as a giant ocean liner that's very hard to turn one way or the other, and we've kind of just been moving slowly forward and slowly upward. Is there any reason to suggest that we won't see that same sort of slow but generally decent growth going forward?
I think that we're looking at probably more of the same, than the same idea of 2 to 2.5% growth. I think the one thing that is weighing on it, and it's weighed on this recovery, is demographics. And I think we've had a slowing in world population. It's not just here in the U.S. where we've seen the population growth slow down, but the issue is even a bigger deal overseas. And on top of it being just slower growth in population, we're also seeing a situation where that population is aging. And people, as they age, have entirely different spending habits. So it's really affecting a lot of industries very unevenly. But I think that's why we've got the slow growth that we're seeing right now in the economy. It's so much to do with demographics. And I think this idea that the Fed or the ECB or the Bank of Japan can solve all our problems and make us grow faster again are probably not true. I think the bigger issue is demographics. And I think we've got more slow growth to look forward to. That's probably not bad news for the consumers, but it's probably not great news for corporations that are used to kind of more unit growth.
Charlie, something else that's slowing down is productivity. What does the effect of productivity, the trajectory of productivity mean for the U.S. economy?
Most importantly, it could have an effect on inflation. Productivity is one of the things that allows you to get more goods and services at lower costs. And what we've had in productivity increases lately, it used to be that productivity improved how fast you could grow crops, how fast you could make a car. The number of people it used to take to do a spreadsheet can now be done very quickly by a computer. Today, the productivity and technology improvements are infotainment, entertainment, healthcare, which are making people live longer, but don't really make us more productive. And so productivity does not have the kind of positive impact on the economy that it used to, and frankly, it's not going to keep inflation down. And so we do think that there's a risk, and we'll come back to this later, on inflation because of the lack of productivity improvements.
So Charlie mentioned inflation there. When you think of some of the other risks, Michael, to the U.S. economy, what are some of the things that are on your worry list?
Well, a lot of it could come from it doesn't take much to knock this economy into recession. As it goes back to this point of if you do get a slowdown in growth, and we're close enough to stall speed that it can become self-fulfilling. And some of the real concerns, some of the weakest pockets of the economy would say continue to be manufacturing. So the more recent data has been mixed just over the last week or so. Manufacturing jobs continue to fall, so people are continuing to lay off people in the manufacturing sector. But some of the indicators, forward-looking indicators, were better. So there's continues to be some mixed messages there. So I think the shocks could come from manufacturing. We think the consumer actually looks pretty good. They've really built up their balance sheets. I don't think it's coming from there. There's a lot of potential for disruption from China. So I think China is something I think we'll touch on later in the panel, but that's always a market that is, one, it's undergoing really important shifts from manufacturing-driven economy to a consumer-driven economy. There's a lot of pent-up debt that has been built up over the previous cycle, and they're struggling to kind of contain their currency right now, manage their currency. A lot of policy response from China could be disruptive to global economies.
And obviously, China is still growing faster in absolute terms than the United States, but their trajectory has not been great recently. So if China has not been doing as well, and the U.S., you say, could be shocked relatively easily given our slower growth, are there any bright spots in the global economy that you think could help if China has some trouble and we see any ripples here?
Well, again, I go back to the consumer in most developed markets looks pretty solid, and so we take that as a positive. I think this kind of bimodal economy with a decent consumer and a pretty soft manufacturing sector suggests for investors is that you really want to think about, to your point earlier, about where are we in the cycle. I mean, this has been a long recovery. It's been a shallow recovery, but it is a little long in the tooth. And for investors, I think the time where you make a lot of money is earlier in the cycle when valuations on stocks are really low and bond spreads are really wide. That's the time to take a lot of risk. And we think that for investors, you really want to be thinking about modulating risk, taking risk down at this part of the cycle. It's not that we think we're coming to an end, but we think being up in quality and fixed income makes a lot of sense. We think that taking down some of your equity exposure at these higher valuations is prudent, particularly for income investors that we focus on.
And Bob, we've mentioned it a couple of times, inflation, and we haven't seen a lot of inflation throughout the recovery, and certainly the commodity prices have kept certain parts and measures of inflation depressed over the last year and a half. But you're starting to see some signs that inflation could be creeping into certain parts of the economy. What are you seeing? Yeah,
I'm a little worried there. I'm not quite as benign on inflation, and that's kind of one of my big worries. I don't think we're going back to a 1970s style recession where everything's up, kind of double digits in terms of prices. But I am worried if you look at what's been holding back prices. It's been the energy sector, which everybody kind of knows about, knows that's going to go away. Less recognized is that goods prices until recently were also moving down as a lot of the cheap dollar or the expensive dollar began to bring the price of goods down. So that kept goods down. But we've had services of inflation, your haircuts, your health insurance, your auto insurance. That's part of the economy has seen inflation of around 3%. And again, that's kind of relatively high compared to past history. And all we need is kind of like some dislocation in energy, and that moves those prices up, or at least they stop going down even. And then you get the goods situation maybe getting a little bit inflationary, and all of a sudden you're staring at some pretty bad inflation problems. And we think you could be at 2.5%, 3% year-over-year inflation by as early as December. And I don't think that's recognized yet. And again, we're not saying it's going to go to 5 or even 6%, but enough to slow the economy a bit. And we're already seeing it in the consumer spending a little bit.
Inflation also on your worry list.
Yeah, I've mentioned it already, but this would be the risk that we think the market is not getting right. The market understands how soft the economy is, the slow growth of the economy. Everybody gets that, we think. But we don't think it's appropriately valuing the risk of inflation. And the other thing I'd add to what Bob said, all of which I agree with, is the U.S. has now run up $19 trillion in debt. The U.S. government has a real incentive to reduce the value of that debt, which they can do through inflation. And countries around the world have been competing to devalue their currencies. So what is inflation? It's the reduction in value of currency. And the U.S. government, Mrs. Yellen, has said it's one of her goals to increase the rate of inflation. And this is one of the things where governments can be very effective when they want to be. And now we think that there are a lot of things lining up right now to get us. I agree with Bob. I'd even be a little bit more worried about higher numbers. The average inflation rate of the last 100 years is 3.2%. And we're actually, most people think we're having zero inflation. The actual number is close to 2% right now, heading north. And so we would be listing this as a very high risk that's not properly understood by the market.
Charlie, I want to stay with you for a moment. We have a question from a reader, Randy, and this is a little bit related also to the point you made about investors and how they position their portfolios, where we are in the current cycle. Randy asked, when the economic growth is projected at 2 to 2.5%, how can my portfolio do better than that? So what do you do when the economy is in a slow growth mode? Where are you seeing opportunities to do better than a slow growth portfolio?
The good news is there is leverage in the world. So if your revenues are growing at 2%, you often can get profit growing more than that. And you do have fixed costs coming down. You have energy is an important cost for a lot of companies, and that's coming down. If anybody is making wall boards or making pharmaceutical or fertilizers, the natural gas price is under $2 is being very helpful. So we do think you can grow profits and have grown profits faster than the 2% GDP growth. Obviously, very low interest rates mean that people are buying back their stock and having their earnings per share grow a lot faster than the overall economy. So earnings have been disappointing, only up about 1 or 2% for the S&P over the last 2 years. We think that's going to get better, and we're going to get more like 6%, 7% over the next couple of years.
And Michael, when you're thinking about positioning a portfolio in a slow growth world, how do you think about doing better than slow growth for your investments?
We've increasingly, over the last year or so, transitioned our portfolio to try to generate our returns on the basis of cash flow. So we have a yield of about 5% on our fund, and we're trying to take very little volatility risk and get to our total return by just clipping coupons, largely from fixed income. So we're at the moment we've had the lowest weight in equities that we've ever had. It's not that we really dislike stocks. We don't think we're about to fall into a bear market, but we look at, say, BB high yield bonds where you're getting coupons of about 6% in a favorable economic backdrop. With a lot less volatility than stocks. We think that looks pretty interesting. Or bank loans where you can get yields of 5.25% or 5.5% with fairly low volatility, particularly compared to equities, preferred stocks. So we've really been diversifying our fixed income exposure into non-agencies and CMBS and these other pockets, other diversifying sectors within the fixed income universe. Not trying to hit a home run at this point, but just trying to hit predictable monthly total returns with as little volatility as possible.
Now, Charlie, you're an equity shop at Ariel, but you're not seeing really any opportunity in fixed income. In fact, you're pretty bearish in fixed income.
No, that's right. We're going to have our first disagreement of the day. We are seeing, we think the area that is the most expensive is people stretching for yield. There's this unpleasant joke about more people have died stretching for yield than through any other cause. And we think that right now people are doing that. There's a safety overvaluation right now that people think they're getting in bonds. And the problem with that is with a 1.8% 10-year Treasury, all of the instruments that we're talking about here are priced off of those Treasuries, which in our opinion are way overpriced. And so we see no make a blanket statement and see no good opportunities in long-dated fixed income, no good opportunities in stocks priced like bonds. Utilities, MLPs are all, in our judgment, overpriced.
And we've also seen a lot of the more equity or the more fixed income bond-like stocks run up in the first quarter as well.
So utilities did extremely well. Absolutely, these high dividend-paying stocks are much higher priced than their brethren with the lower yield, and we think that will reverse when we get more inflation, higher interest rates.
So let me take a stab at that one. So I would agree that there's no value in treasuries, particularly at 180 on the 10-year. On the other hand, when you look at some of the global forces that are keeping rates low, when you look at German 10-year bond yields, which are close to zero, or you look at Swiss 10-year bond yields, which are negative, and so on, there's a lot of international money that will look at, say, 1.8% on the 10-year, and they think that's pretty interesting. And we see this a lot from our overseas clients, where the difference in policy response from the East European Central Bank and the Bank of Japan, they're going to continue with these policies and keep those rates really low. So we don't see in the short run, certainly in the intermediate run, that's a different story, but in the short run, we don't see a big risk to rising interest rates. But we're looking more at the spread sectors within fixed income, whether it's high yield or preferreds, and those are much more geared to the economy. And we think that combination of spread on top of albeit fairly low treasury rates, if you can get to a total return of around 5.5% or 6% in this environment, that's a good place to be.
You mentioned the central bank policy there, global central bank policy. I'd like to turn and talk about our domestic central bank policy. The Fed has obviously been trying to get out of the extraordinary stimulus measures that we've undertaken over the last several years, really since the financial crisis. Bob, when you're looking at the actions of the Fed, and the market has just been obsessed with the Fed over the last year or so, you know, when they're going to raise, when they're not. I don't really necessarily want to talk about that, but I'd like to get your insights about the way that the Fed is going about normalizing policy again. If you're going to give a report card to the Fed, how they're doing, how do you think it's going so far? And the policy is a very slow sort of wait and see, and then we'll raise rates if we can.
I think they've been dealt a relatively poor hand, and I think that they've done a decent job of adjusting. I would say that the one thing that we've got is that they've certainly had a hard time trying to communicate where they are. And certainly as we sat here last year, we were talking about what words were left in and out of different policy documents, and we're still kind of sitting there at that level. And the one thing that's probably bothered me a bit about the Fed is that they've talked about, well, we're going to watch the labor market and we're going to watch inflation. That's our charter, and that's kind of what we're watching. And, you know, we've got the labor market relatively strong right now, and it's kind of met their parameters for, like, okay, this is not an abnormal situation anymore. And we've certainly got, in our minds, inflation is back up again. They've gotten a little help from energy prices lately, but other than that, you know, I think they've got inflation where it needs to be. And so you'd be thinking they'd be wanting to, you know, raise rates and normalize things more than they have. And instead, they've kind of said, well, now we're worried about international, now we're worried about something else. And so they've added a lot of caveats to what was a pretty straightforward message a year ago, so we're watching these two things. And now everybody's a little uncertain of what they're watching, and that uncertainty, as we mentioned, isn't a good thing, because when you're on this cusp of growth, uncertainty is the last thing you want. Now we're kind of like, well, what's going to be their excuse next month?
Well, it also seems that if inflation is, you know, the risk, as we've talked about, that could be heating up faster than expected, this sort of wait-and-see method that the Fed is undertaking, they might not be able to, right? I mean, if we start to see inflation come in, they won't have a lot of time to wait and see anymore, right?
Right, and this is what always happens. I mean, the Fed is always behind the curve. If you look back over the last 50 years, I mean, they don't want to move to, you know, they want to err on the side of caution. They don't want to take away the punch bowl too soon. There's seldom examples of where they really pulled it away too soon. And I think in this case, you know, they are waiting to the very end, and I think they were kind of on the right track, and this swoon in energy in February really kind of threw them off track. And I think that's they'll regret not having started to raise rates again here in 2016.
And Charlie, recently we've had the 10-year at 1.9. I think it even went lower than that recently. Where do you think a normal 10-year interest rates, if we know what normal 10-year interest rates should be, how far away are we from a normal environment?
This is where we think you can look at history. The people have been issuing 10-year treasuries for 100 years, and the average number is closer to 4%. A 3% inflation rate and a 1% real return on top of that. We have never been this low, except for the day after Pearl Harbor. We've never been below 1.75%. So we've now been bouncing around this level for 3 or 4 years. But other than that period, we were never below 2% except for the day after Pearl Harbor. So this is very unusual low interest rates, and we think we're going to go back more to the traditional 4%.
And when we're thinking about a rising interest rate environment, Michael, and you're thinking about trying to position a portfolio that has lots of different kinds of assets, some of which will be much more rate sensitive, how do you position for an environment where maybe we don't know exactly when it's going to happen, but it's going to happen at some point? What do you do to prepare for that?
I think it may happen, but if you just look at what the bond market is pricing in, so the bond market believes that 10 years from now, if we're sitting here watching this again, and sitting on this very same set 10 years from now, that the 10-year Treasury yield will be about 3%. So we're talking about looking out 20 years, the bond market. Now, this is maybe a very pessimistic view, and that says something about how much pessimism there is in the bond market, but the markets believe that rates are going to be low for the next 20 years.
And that's the danger. That's what we're arguing with. I agree with that, but that's
what's priced in. So we think that's probably excessively pessimistic, but it's also suggesting that the markets believe that growth is going to be much lower than historical averages. And we think there's something to that. And I think, it's important to differentiate where you're taking interest rate risk. So if inflation does tick up, I think probably the most vulnerable part of the yield curve is going to be at the front end. And that's where I think if you're looking for any mispricing, and if you think that inflation is going to surprise, you have to assume that the Fed is going to become more diligent. And right now, when you look at what's priced into rate expectations, it's very benign, slow move higher in short-term interest rates. And that's what we've hedged out of our portfolio. We're concerned that the bond market is mispricing the trajectory of Fed rate hikes. And so we've hedged out that risk using interest rate futures from our portfolios. We're more comfortable, again, from a short-term tactical perspective, owning longer duration assets because we think those are being driven by more of these global dynamics, namely really low, if not outright negative interest rates from overseas markets.
So I want to talk about negative interest rates just quickly because we've been hearing about that. Janet Yellen mentioned that negative interest rates are off the table for the United States. But what is this idea of negative interest rates? How does it work, and why are some of the central banks undertaking that policy? What do they hope to get from it? Can you explain that?
Well, it started with the idea of lower interest rates will stimulate the economy, and particularly we've seen in Europe and in Japan, rates went to zero and they still weren't able to jumpstart life into the economy, and so they pushed them negative to where, as investors, you actually have to pay to deposit your money, which is a really bizarre notion, but that's where we are, and it's also pushed down interest rates across the yield curve. So you're dealing with in Germany, you have negative interest rates out to 7 or 8 years. Those rates are negative. It's hard to believe, but it's the case. And in Switzerland, it's even more severe. And I think you're starting to hit tipping points on the benefits of lower interest rates. It's meant to stimulate the economy. It hasn't really worked very well yet, but cracks are starting to emerge in this policy experiment, namely in terms of the profitability of some of the big European banks who had very difficult earnings in the fourth quarter, and you've seen their share prices fall dramatically. They cited negative interest rates. With negative rates, really hard for banks to turn a profit. And if you start to undermine the stability of the financial system, that has really negative implications for the broader economy. So I think the ECB heard that message loud and clear. They're still going to continue with stimulus, but they're going to use different tools rather than pushing rates lower and lower.
Bob, Michael mentioned that lower interest rates haven't necessarily stimulated the economy as much as they could have. Do you think that we've reached the end of low interest rates, and why, if low interest rates aren't working as well as we'd like, why not? Why aren't they having the impact that we would want?
Well, I think a lot of it is kind of related to some of the demographics issue. I think that the demand for money is not as good as it once was. I mean, certainly here in the U.S., we've seen that's true. I'll say less so maybe overseas. But here, as our population growth is slowed, I mean, you don't need a new factory to produce more milk or more whatever when you've got no population growth. You just make the old stuff work more efficiently. That's all you've got to do. So we haven't got this big demand for money from new capital equipment. And so and a lot of the developments that we've seen in technology now relate to social media and that type of thing. Where you don't need capital investment. And so we've seen business spending has been one of the things that's kind of been holding back the recovery this year at least. And it's kind of unusual. I mean, we've all kind of talked about, the consumer is kind of a key driver, but, kind of behind that message is that business spending is kind of going nowhere, even with interest rates that are practically money for free. So I think a lot of demographic issues are really kind of weighing on this, that companies don't need the money as much as they once did, and certainly a lack of confidence in where the economy is going, a point that we've alluded to in the past, is probably also holding them back. But again, consider a slow growth world that's more focused on technology and social media, that you just don't need capital in the way when GM was a key driver of the economy.
Charlie, I'd like to jump over to a reader question. This is related to inflation, but also the costs that companies are bearing now. Gerald is asking if you have any thoughts on the push to $15 minimum wage and the effect that that could have on inflation. What does that mean?
I didn't plant that question, but I'm glad that person asked, because a part of inflation is push inflation, is the costs that come through the system contribute to inflation. There are lots of different things that cause inflation. Monetary policy, more money in the system causes it, demand causes it, but costs cause it. And we are going to have increasing labor rates in the country. It's not going to be $15 a year soon anywhere, but minimum wage rates are going up. This is not well understood, but the actual population moves. There have been more people go back to Mexico than come this way. So the available labor force is actually gotten a little bit smaller, and that's going to push rates up. Health care benefits and the increasing benefits that people have to pay when they hire workers is going to push inflation up. So all of these factors, the price you pay for a hamburger at McDonald's is influenced by what they have to pay for the person that grills that hamburger, and that number is going up. And we think we've had a lot of things that have driven inflation down. We've had low food costs. We've had low energy costs. We've had low labor rates. But all of those things, including a strong dollar, are, in our opinion, about to head the other direction.
And Michael, we had another question specifically on inflation, and I think there are a lot of different ways you can track inflation. But John is saying, what are some of the ways that you might want to look at inflation, because you have the core and then you have other measures, and then there's measures for folks in retirement as well. And some people might be feeling a lot of inflation, and other people might not be feeling as much. So how do you get a handle on the inflation measures and how fast some of them are moving up?
No, it's a tough question, and inflation is tough to measure because there's so many different influences. And your experience, I'll speak for myself, my experience is that inflation is running hotter than the government statistics. I certainly feel like my cost base is definitely going up faster than is being measured by the government. If you look at headline inflation, which includes food and energy, that's the most volatile part of it. I think we're at levels where the falling oil prices, which have kind of dampened the headline inflation, are about to roll off and become less important. So to some of the points made earlier, I think you're going to start to see the official numbers start to pick up. But if you strip out food and energy and you look at core inflation, it's actually been drifting higher. So I think this does raise a really important point around corporate margins. So some of these cost pressures that have been building up, we've seen peak margins. They were extremely high, and it was really impressive, the profit margins that the corporate America were able to generate over the last several years. But those have started to roll over on the back of some of these cost pressures that are starting to build. And just in the latest fourth quarter GDP release, we saw the corporate profit share of GDP fall double digits, which is pretty I shouldn't say unprecedented, but it's very unusual. And this is where we struggle a little bit with the upside case for equities, because you look at falling margins and you look at earnings growth, which has not been terribly exciting, and you compare that to an S&P with a multiple of 17 times, that's a big number. And we think that number is pretty bullish. That would suggest that investors are pretty bullish on markets. But we compare that to pockets of fixed income, particularly up in quality in some of these other in high yield, or we look at prefs and so on. Those spreads, particularly if you went back 6 weeks ago, were absolutely at recession levels. There's a lot more bad news priced into the bond market than the stock market. And it's this disconnect that has us taking down our equity weights and pushing more into fixed income.
You mentioned commodities there and the impact that lower commodity prices can have on companies, but we've also seen commodities have, ideally, a beneficial impact for consumers. They would have a little bit more money to spend. But I do want to turn the conversation to commodities. We've had a lot of questions on what is the effect of low oil prices on the economy and on companies. But I would like to start first by just talking about Charlie, I'll give this question to you. Just talking about the fact that U.S. markets, and maybe even global markets, and commodities have been so tightly coupled. Every day it's crude has gone up because they're going to make a deal and stop production, and the markets go up. Oh no, maybe, Iraq is not going to participate, so then crude comes back down, and the markets come back down. Why are they so closely coupled recently?
Yeah, and this is disappointing to us. We did believe that drop in oil prices would be good for the U.S. economy. It's certainly good for the consumer. I think it is two things. It's correlation. It's the perception of weakness in China causes oil prices to drop, which weakness in China has other effects which cause manufacturing companies to make less money. So they're correlated as opposed to causal. But it is causal to the degree that banks have made a lot of loans to oil companies. And if a lot of these people go under, banks are going to have a lousy time. The state of Texas, the state of North Dakota has made a lot of investments in the energy business, and that's going to get tough. So we do think that in the short term, oil prices dropping is going to be disruptive to the high yield market, where at one point it was close to 15% of the high yield market. It's less than that now. But we're now, with oil back closer to $40, we do think we're at the point where the stock market and the oil market won't be quite as close as they had been.
And Bob, have you seen, when you look at the consumer data, have consumers been spending some of that extra money they've been saving at the fuel pump or not?
Well, there's kind of two things going on. I think some of the numbers would indicate the consumption hasn't really benefited all that much from the lower prices. But then you start pulling it apart, and yeah, it has. There's some consumer categories that are doing unbelievably well. Restaurant spending is up something like 8% year over year. I mean, that's almost unheard of. And luxury travel's another area. Overseas travel, we're up in double digits. Spending on sporting goods, spending in many categories that might be considered luxury or discretionary items are doing very well, and just not the high-priced ones. Kind of the mid-size SUVs or hunting equipment or whatever. All of those kind of semi-discretionary items are really doing quite well.
Does that suggest consumer sentiment is pretty good? I mean, I know that you're not a huge fan of consumer sentiment, but if people are spending at restaurants and they're spending at sporting goods and they're taking trips, I know Carnival's earnings recently, more people are booking cruises and they're booking them further into the future. The consumer is feeling better then.
Absolutely. I mean, and some of the statistics we saw on Friday, I mean, again, I'm not one to look at the big statistics on consumer sentiment, because I think I can get real-time data faster than those surveys are compiled. So I'm not a big believer in those, but nevertheless, the consumer is spending. And this idea, he's not spending, well, it's being held back by, you think about gasoline, it could go to nothing and I'm still not going to drive anymore. My thrill isn't driving my car around. And so there's a lot of categories in there. Food's another one. I mean, especially with the diet craze and people being more careful about what they're eating. And they're eating out more. The food spending isn't going up. And so there's a lot of categories that are a pretty big percentage of consumer spending that aren't going up, not because they don't want to, but it's just kind of, we're satiated, if you will. And so I think that's confused a lot of the numbers. So I think consumers have been spending more of their money than people think. And then there's one negative side to that, too, in that I think a lot of people are now spending more of their money on rent. And more money on health care than they used to. And so there's this perception that they aren't spending as much, but they are spending a lot on those items, which kind of weighs on the data as well. So that's why some of the conventional retail sales, as we've all mentioned, haven't looked so great. Well, maybe they're spending more on health care, they're spending more on trips, they're spending more on restaurants. They're not spending the way they used to. And again, that flows back to some of the demographic trends that we've seen, that older people tend to spend on health care and travel and less on more clothes and more furnishings.
Michael, Charlie mentioned that some of the knock-on effects of lower oil prices in the financial services sector, because banks might have exposure to some of these E&P companies, exploration companies that may be overstretched a little bit. When you think of some of the negative knock-on effects of the low commodity prices, are there any concerns there, particularly in the high-yield market or the market of companies that don't have great credit, but they have a lot of exposure to energy? Is there risk there for the economy?
Well, I don't know that there's a lot of risk for the economy, because if you look at the overall portion, the energy-related exposure in the high yield market as a percentage of the total bond market, it's about 0.5%. So I think the potential for contagion is pretty low. Can it roil, and has it roiled the high yield market? Absolutely. And we've been really cautious on the entire extraction market, so energy, metals, and mining, for a long time. So felt like we were very well positioned for in our portfolio for all the turmoil that hit really starting about the last year or so in the bottom end, the really low quality, the yield stretchers really got hurt, particularly anyone that had exposure to MLPs as well as energy related high yield. So those prices have actually bounced a lot in the last 6 weeks or so. We're still not believers, and we're still really wary about some of these fundamentals. I don't know where the clearing price is on energy, but I think we'll find a equilibrium more quickly in the energy-related markets than we will in, say, the mining and the mining sectors, where we think that there's just chronic overcapacity, and the demand that was so driven by China is not coming back. It's a lot easier for supply and demand to meet in the energy sector, but the longer we stay at these low prices, the more a challenge the viability of a lot of these MLPs and a lot of these very levered energy and E&P companies.
So while Michael said he wasn't sure exactly where that clearing price is, do you have a sense of what you think long term? And I'm not talking to you to predict what's going to happen in the next 6 months, but what's a normalized price of oil, given that we have some secular changes like lower demand from China, for instance? Yeah. What is the normal price of oil? What can we expect it to converge to?
You know, I don't think any of us know for sure, but certainly we all talk about with our energy folks that, you know, the cost of taking that oil out of the ground and what is the marginal cost that you've already got the sunk cost, your wells in place. What's that extra cost of pumping another gallon out? And again, it's way different by market. I mean, in Saudi Arabia, it's pretty darn low. For our shale guys, it's relatively high. And so it's kind of, as the supply and demand comes, it usually comes down to the kind of the last players in the market. What's their marginal cost? And I think that number was probably in the $50 range or so. But again, who knows? And we've all been wrong on energy forecasts in the past. I think that it's an important role in the economy. I don't think we're going back to the sky high prices again. Marginal cost analysis, which is kind of the logical way, but markets don't always operate logically, suggest a price certainly probably right around the $50 range. But I certainly think we could go higher than that, and we can go lower than that, because, you know, energy is something that you can store for a long time, and it takes a long time to ship it. So that's why, and you can buy futures on it. So that's why some of the data gets so confused. Supply and demand aren't really all that far off right now. And what's interesting, and this is really a supply problem, not a demand problem, energy demand overall in 2015 grew at a higher than average rate than it has over the last 20 years in 2015. And so
you're talking about global energy demand? Or
global energy demand.
So what made up the difference if China was, if you know, the conventional wisdom is China is not buying energy anymore, or is not as much, right?
Well, certainly at lower prices. We've bought more here. We mentioned buying cars that are less energy efficient here. It's kind of been the trend. Our energy use here is clearly up. Our miles driven here in the U.S. After years of being down was up over 3% last year in terms of the number of miles each car is driven. So really, and there are other areas where energy demand has gone up. And by the way, the demand from China is still there. Their demand for oil was up last year. It just wasn't up as much as everybody had thought it was going to be. This is not a demand issue. This is not China's demand going away. This is like unbridled supply.
Okay.
I think, by the way, I think Bob's point on the motivations for some of these shale producers are not. They may not necessarily be rational at face value, because they will continue to pump even if they're not turning a profit, because they need the cash flow. They can't not pump. They need to make their next debt payment. And because so much of this was financed in the high yield market and they use a lot of leverage, they have to keep going, even if it's not profitable right now. They need to keep the game going. And that has been, I think, an important dynamic in why you haven't seen the supply fall off as sharply as some might have thought.
Exacerbating the supply issue,
Right.
effectively. I'd like to turn and talk and end our discussion with talk about corporate earnings and also valuations and some of the different areas of the market, sort of tie this back to actual investments. And Charlie, I'll start with you because you have some interesting ideas about recent performance that we've seen, but also where you're seeing opportunity in the market. And it's somewhat contrarian, perhaps not surprisingly, coming from Ariel. Can you talk about, given what we've seen and some of the factors, where you're now seeing some opportunity in the market?
So, thank you. We are seeing that there's this risk premium that companies that are perceived to be economically unsensitive, low beta, if you will, are, in our view, being overpriced. And companies that have cyclicality are very cheap on a relative basis. When we rank all the companies in our portfolio from most expensive to cheapest, based on our calculation of intrinsic value, all the cheapest stocks are the names that have economic exposure. And all the most expensive stocks are the very low beta, low cyclicality stocks.
Does that include energy names?
It does. It does. You got to be careful in energy because they got to get to the other side of the trough. But so energy supply companies, for example, we have a company called Bristow, which flies helicopters that service deep water drilling rigs. And that company is right now selling for about 40% of the value of its helicopter fleet. There's a very liquid market for helicopters, and there's a very depressed stock price, way below liquidation value. Ben Graham would love this company if he was still alive. U.S. Silica, which provides the sand that's used in drilling, is trading at an extremely low price. And the same thing is true of financials. Banks, Morgan Stanley is trading at 70% of book value. They have a portfolio of some stocks and bonds, and you can get that portfolio today for 70 cents on the dollar and get Morgan Stanley's M&A business and their advisory business for free. And the reason is because they are tied to the economy. If the market goes down, Morgan Stanley is going to go down more. There's no doubt about it. But in the long run, right now, we think there is an excessive premium being paid for stability, for non-exposure to the market, and you're not going to earn a good return, in our judgment, investing in those quote-unquote safe stocks
So
today.
this is consumer defensive names or utilities names.
Overpriced.
So look elsewhere, but you have to have some stomach, right, to do that.
No, absolutely. And that's one of the lessons that we think history has taught us is the people who do poorest are the people that look at their portfolio every day. Because all the behavioral finance teaches us, we all overreact to losses and underweight gains relative to losses. And so if you look at your statement every day, you're going to put too much money in safe investments. And so it's much better to take a longer horizon, particularly right now, when you are, in our judgment, being paid to take that cyclical risk.
So, Michael, I'd like to turn to you because I think you've cast some defensive notes, generally sort of how you're thinking about the markets. But what does that translate to with your investment plan? And given that the market has been volatile, but is essentially sideways for the first quarter, and we've also seen several years of good performance, are valuations looking attractive? How do you think investors should be thinking about their investments, given everything that's happening right now with valuations and the economy?
So we manage the multi-asset income fund to deliver a pretty high level of yield, around 5% with low volatility. And so to meet those ends, we've been positioning in general away from stocks. So I would agree that I think the cyclical parts of the market are more attractively valued than particularly areas like utilities. I think probably the most expensive part of the market are the very highest yielding stocks, which I think I would agree are really unattractive. But on the cyclical stocks we've got in the portfolio, we've got about 13, 14%, but we've overwritten them with call options to generate more income. And because these cyclical stocks are more volatile, you actually get paid a lot of money to sell 5 or 7% out of the money options on these types of companies. So I think the market will go up, will drift higher, but we think that the likelihood of, say, double-digit returns for the foreseeable future on equities is pretty low, which is why we think that selling these call options is an interesting idea to supplement yield for income investors. And then the other 3/4 of our portfolio are invested in a variety of different fixed income markets. And I mentioned earlier, we're wary of the potential for a big move higher in short-term rates, and so we've hedged out that risk. But tried to look across different markets, whether it's high yield and bank loans and non-agency mortgages, and commercial real estate we think is a really healthy market. You can own really low quality, very volatile commercial mortgage-backed securities, or you can own higher quality and sacrifice some yield, but generate very low volatility. That's our preference. So across our portfolio, we're positioning for later cycle, up in quality, not taking a lot of risk, and we've got a volatility of about 5%.
Bob, we're heading into first quarter earnings season shortly here. When you mentioned before about some of how corporations are spending their money, but also we've talked earlier about profit margins, and there might not be necessarily a whole lot more to eke out of that. What should investors expect from the corporate sector as far as earnings growth, margins, contribution to the economy?
Well, I think we're at an interesting dynamic in the economy right now. I think the demographics would argue that labor is about to get a bigger piece of the pie. We've actually seen a number of labor market shortages. Drywallers, pilots, airline controllers, chefs. I mean, every day the list gets longer of people saying, you know what, if I could do better, if I just could hire more people. So I really think that we've got this issue of labor shortages weighing greatly on what we're doing here. And I think that's one of the key dynamics of what's going on.
Do you think that businesses then spending more on labor but not investing back in the business? Do they not need to invest as much back in the business? What about business spending?
Yeah, I think business spending overall, I think I'm relatively negative on business spending because in general you don't need the green plant operations that you used to. With the economy growing slower, you don't need the working capital needs that you're used to. But I do think there are a couple of areas of corporate spending that may be interesting. I mean, I think certainly with labor shortages, anything that makes people more efficient is going to do well. And I think that could be a case for some select areas in technology begin to look a little bit better as labor-saving devices. And I think that's an interesting area to look at. I think there are other areas like that, like travel may be of interest because of the demographics that are out there, and people may spend maybe in some of those categories. So I think there's a lot of interesting things going on because of demographics in terms of business spending. But I think in general, labor in most businesses is at least a third of your cost. And with these labor shortages ongoing, I think that's going to put a lot of pressure on corporate earnings. I think higher interest rates, whether it's a little or a lot, it's going to put some pressure on corporate earnings. And we've got this generally low level of growth. And of course, the whole story about getting costs down is a little bit more revenue flows straight to the bottom line, this high marginal profitability syndrome. And now with more limited growth, higher interest rates, higher labor costs, in general, I think corporate profits are a lot to worry about here. I'm very concerned. It's actually good for the consumer and the individual that more of the pie is going to flow over to them. It's not so great for corporate earnings. But and again, the selectivity that Charlie's talked about. I mean, there's some people that have very low labor costs, serve the middle class with their products that could do exceptionally well. So this idea that the broad markets are going to do one thing or another are of interest generally. But I think this may be an area where individual stock consideration and what are the key demographic trends driving their businesses will be the key determinant of who's successful.
All right.
The same thing would apply to individual bonds, I would point out. So those benefits also translate over to the fixed income side of the ledger too.
I think we'll have to end it there. It's been a great conversation. We've covered a lot on the economy, but also I think how investors should think about their portfolios in these very interesting times. Charlie, Michael, Bob, I'd like to thank you so much for joining the panel today and for your insights.
Thanks.
Thank you.
Thanks for having us.
Everyone, stay tuned. At the top of the hour, we're going to have our second session, and be sure to not go too far away from your computer screen. We'll be right back. I'm Jason Stipp from Morningstar, and thanks for watching.